to Mutually Speaking by Navy Mutual. We are dedicated to educating military service members and their families on matters of financial security. The Navy Mutual Aid Association Mutually Speaking podcast is intended for general informational purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations, solicitations, or construed as legal or tax advice. This podcast is not meant to replace the services of a licensed financial planner, insurance counselor, or tax advisor. Programs mentioned and other information referenced in this podcast may change from time to time. If you have questions or comments, or if there's a topic you'd like to learn more about on this podcast, contact us at podcast@navymutual.org. Today's topic is investments. Unless you've done a lot of research on your own and started dabbling on your own time, you may not have a lot of experience with investments or even know where to begin. Investments are crucial to planning for retirement, though, so to ensure you're prepared, we'll dive into the basics today. We'll go over investment considerations, time horizons, and the difference between loaning your money and owning investments. Excited to talk with you today about investments.
Well, thanks for having me. I'm looking forward talking about investments. This is one of my favorite topics and one that could fill hours of conversation.
Well, we don't have hours, but I'm sure we'll be able to fill what time we do have.
Okay.
So I guess to get us started, what would you say are some major investment considerations?
I'd start with you start with the end in mind, right? So your investing should have a purpose. So most people are investing for a particular goal. The largest one I would say would be retirement, right? And then, but as everyone is on a financial life journey, on their life's journey, it could be saving for a house, it could be saving for college education, could be saving for a nice vacation, right? So you should have an idea of what you're investing for. Are you investing to grow assets in your accumulation phase of life? Are you going to provide income? Do you want to transition to assets and income? So start with the end in mind, know what you're saving to your goal, because your time horizon to achieve that goal could affect how you allocate your investments.
So what would be the time horizon? Like, I think we touched on it a little bit on the last episode, but when we're talking about investing, what is your time horizon?
Well, like I said, so your time horizon could be driven by multiple factors. So it could be, if you're 18 years old, you have a long time horizon, but if it's for spring break and it's 3 months, you have a short time horizon, assuming you're in college, right? So you have to, it will vary on person to person, and it will depend on their age, and it will depend on their family status. So you would have to figure out from those goals what and the timeline you have for this specific goal, because one person could have multiple timelines. As I said, I could be planning for a vacation this summer. I could be planning for Christmas. I could be planning for, if I just had a kid, the child, and I say I want to pay for my child going to college. I could have 18 years before the first one there. If I'm trying to buy a house in 10 years, and if I want to retire, however many years for the retirement. So you would then figure out, based on that and your risk tolerance, am I trying to go for growth, which growth tends to have a higher rate of return, it has a little more risk, or income, which is a more conservative, but it's easier to plan against. So in the end, that's where taking all those factors into consideration and your risk tolerance will result in your allocation on asset type.
Got it. And then, so when we're talking about time horizon, I think that also touches on there's a cyclical nature to the stock market, right? So there's like, I don't know as much about it as you do, obviously, but the economists, they're talking about like bulls and bears, like a negative outlook
or a positive outlook.
Right.
So how would you take into consideration like the cyclical nature of the stock market?
Right. And so there's lots of people who say they can forecast the market, but in practicality they don't really exist. So, but there are market cycles, and that it exists. That's why you have in front of Wall Street, there's the big bull and the big bear, because you have up cycles where it's a bull market and everyone says, hey, we need to be fully invested in the market. We're in a bull market. It's going to go up, up, up. And then you have the contrarians, the bears that say, no, these valuations are inflated and we're going to need a correction, and then the market will go down. And so the market does go up and the market does go down at various stages at various times. We've had a particularly good run, I would say, in the last 10 years, although shortly after the pandemic hit, the market went down precipitously, and the bears said, hey, the market's done. But the pandemic was not a structural problem with the market or the economy. It was more like a natural event, right? And so once that cleared, then the market went up. But the market went down 30, 40% in a very short time span.
Right.
And then, but then as people got comfortable and understood this too shall pass, and then the market made actually a rather remarkable rapid recovery. And then it went up again for another 2 years. And then last November of 21, you started seeing inflation kicking in. And in response to inflation, interest rates, the Fed started talking about interest rates. Interest rates are an externality to the market that can affect it, not infected like the pandemic. And so growth stocks that didn't have any competition from an interest-based asset, right, suddenly find themselves in. And so we saw the NASDAQ, which is heavily focused on growth stocks, started going down as people responded to say, hey, I want to reallocate, because if the interest rates go up, I can get some conservative rate of return there. So the market will have cycles up and down. And then over the last 20 years, 30 years, right, we've seen Black Tuesday where the market dropped precipitously. We saw the .com boom where everybody said, hey, the internet is here. It's going to change everything. And it did. I don't want to say that the world is the same pre-internet, right, but not every company that had a .com at the end of it was going to be a successful company. And so there was a lot of companies that did not make it through the .com boom. Then we had a real estate, and then 2008, and we saw that it went down. So, just in the last 30 years, you can see multiple examples of the cyclical nature of the market going up and down. So if you have a long time horizon, you have long time to put your money in. And if the market goes down, you don't worry about it because the economy is growing, America is growing, the population is growing. And so over time, the market has maintained 7 to 9% annual rate of return. Now, a particular year, it might not be there, but on average. So if you have a long time horizon, you can wait out the
right,
down times, right? If you have a short time horizon, if you had put all your money into the market in January of 20 and you needed it, to put a down payment on a house in May, and you say, okay, I'm going to get some market growth like I've seen for the last few years, you would have seen your down payment drop 40%. You would have gone from that mansion to a condo, right? But if your horizon had been a year, you would have actually made money from the January to the following January. So if you have a shorter term, you need to be more conservative in your investments. Don't bring so much volatility into your portfolio.
Yeah. No, and I think that goes back to of what you've said many times previously is that personal finance is personal. Mm-hmm. And so that's going to affect what you're deciding as your investment objective, growth versus income. And it's also going to dictate your time horizon, what your goals are.
Right.
And then I guess it would also definitely impact taxes and how you take those into consideration with your investing.
Absolutely. The one thing I would add to your comment, though, is as we do our journey, often there's a significant other, right? So then that personal journey is between the couple. And one thing that you have a risk tolerance, I have a risk tolerance, and a couple will have a risk tolerance, right?
Sure.
And so when you do that family planning as we go through this financial life journey, having one person drive the risk for the family goals sometimes can lead to friction. So part of what we do when we're looking at this is to sit there and then figure out what the family risk tolerance is, and then allocate your, because money in the end should bring peace of mind, right? And
Sure.
so we don't want it to be a point that causes friction with people. So
Even though it always is.
right, but speaking of friction, who hasn't felt the frustration of the tax van coming
Yes.
and where'd the rest of my paycheck go? For that
Right.
teenager who starts their first job and understands the concept of taxes, right? Or, hey, my bonus is going to be so big, except for it's not, because there was a bunch of taxes. So taxes are a necessary evil, right? But it is a planning factor, right? So not only are you planning for on your journey your asset allocation, right, between equities or fixed income or something like that, but you're also thinking about your tax strategy, and then as you plan for whatever your finance objectives are, you have to allocate so that you don't want to pay more taxes than you need to. Warren Buffett famously gave an example about the tax rate being a planning factor, and his secretary paid a larger tax rate than he did, because he had tax advisors that told him how to allocate his income such that he paid more in taxes than she did, but his rate of paying taxes was lower than hers. So she was actually paying more of her income in taxes than a very wealthy Warren Buffett. The point being, taxes are a planning factor that you need to consider. So you have a couple of vehicles that you can use to do that. You have regular investment accounts, or you can use tax deferred accounts, or what I would call tax free accounts. So if you're investing and you have the ability, you can put it into a tax deferred account. So that money will go in and grow tax deferred until you pull it out. An IRA is a typical example of that. You don't pay taxes now, and then in the beginning stage of your career, you get to deduct the money you're putting into that tax deferred account from your income, and so pay lower taxes. Now, a Roth type vehicle, you're paying the taxes up front, you put it in, it grows tax deferred, but at the end, you don't have to pay any taxes on the money you withdraw from a Roth IRA. So when you think long term and you look at your investments, one of the things you should consider is, what do I think my retirement income is going to be? And then have a tax strategy for retirement, as well as a tax strategy during your earning years. So that would be, if you think you're going to have a lower income when you retire, and you're not going to be at a higher tax bracket, then you can put all your money into a particular tax deferred, like an IRA or a 401k.
Sure.
Right, so they grow tax deferred, but when it comes out, you're paying taxes on it.
Sure, but if you would expect to be in a much higher tax bracket, then you would want to have disperse that so that your tax bill isn't as large. I guess you would have to plan that out, right? So
you would have to. So when you take a look, so you have your assets and you have your investments. And so you're thinking at various stages of your life. So some of the examples just the stereotypical, I have a kid, I want to do vacations, I want to do college. Then after I get the vacations done and I get the house done and I get the college done, then I maybe start thinking about retirement. So I'm putting stuff into retirement. Maybe I think about long-term care, depending on what my family history is. And so for a good portion of my financial life, I am busy accumulating assets. And then at some point I stop working, and whatever I have then is what I have to live for the rest of my life. And then as you look at there, you say, okay, now where is my income going to come from at this point? Social Security is a type of fixed income. And so that's a whole decision on when to take Social Security. Do you wait to 70 and maximize it, or do you take it at 62 and get it as early as possible? But so that would be one layer, of fixed income that you could plan to. If you wanted to ensure that you had your essentials done, you could take some of your investments, turning it into an annuity of some sort, and then that would ensure that income is guaranteed. And then you could take the rest of your assets, and then a typical rule of thumb right now is 4% of your total assets you can take off. Now, these investment accounts have required minimum distributions where you'll have to take out. So as you look at that, your income for Social Security counts as income, your annuity counts as income, and then this 4% that comes out counts as income. And so you would want to take a look at your tax bracket and say, if I take out 4%, I could go from a 15 or 18% tax bracket to a 22, and then now you're paying more of your 4% withdrawal in taxes. Or maybe you say, I got a windfall, or I got some kind of buyout or something. So you'd say, maybe this is the year that I take money out of my Roth because that's coming out tax free. So you want to manage your tax bills, because in the example of Warren Buffett earlier, the higher the rate of tax that you pay, the faster your retirement funds will be consumed. So, you want your money to last as long as your life, right? So having a tax strategy for how you take out your investments is as important as your tax strategy as you build up your investments.
Yeah, no, that's a great point, and I think that's probably something that's a bit overlooked in terms of, like, I think that example you gave of, like, the teenager starting their first job. I'd imagine that there's a similar moment when people are retiring of, like, not realizing that tax deferred meant deferred now.
Right. So
that point when you're retiring.
So arguably the largest tax bill that any retiree has is the taxes they owe on their retirement account. So when you look at that retirement account, if you're getting Social Security, you can figure anywhere from 10 to 22% of that. So if you think you're a TSP millionaire and you haven't factored in taxes, you're really a TSP 3/4 millionaire, right? And a lot of people don't think that through. They think, okay, everybody, works towards a retirement number, and once I have that number, I'll be able to pay off my mortgage and then pay for my travel or do whatever the things they want to do, go fishing, play golf, whatever. But if you haven't figured out that there will be a tax taken out of all of that money and factor that into your cash flow analysis in your retirement, then you're going to find yourself
up a creek,
cutting corners, right? Because you're going to have to balance the books.
Sure. So you have to think past the number.
Right.
Yeah. Okay. So then I guess to go back to different types of investments, I think nowadays investing has become a lot more accessible to people, with the apps like Robinhood and Coinbase and
Coinbase,
Acorn, things like that.
Mm-hmm.
So I know we talked growth versus income, but how do you decide where to invest?
Right. So I think one of the first things is, as I mentioned earlier, is you have to understand your type of investments and then your risk tolerance. So you can own an investment, buying stocks, which is a partial share in a company, or a mutual fund, which is a collection of stocks, companies in a particular industry, right? So an index fund could be an index fund on the S&P 500, right? Or you could have like in TSP, the TSP has a small cap fund. So a company in that fund has to be a certain size or below. It could be a large cap fund. So the company conversely has to be larger. ETFs or something like that is an exchange trade fund is similar to a mutual fund, except it trades like a stock, but it still has the same objectives, right? So if you have a utility ETF or a utility mutual fund, you will have a lot of utility companies in there. And so an industry has some risk and volatility, to our earlier point, and it has market cycles that go with it. Oil for a long time was going down, right? There was a surplus of oil, and oil went down to $30 a gallon. In fact, there was a barrel. At one point, there was so much on the market that people had to pay for storage of the oil, right? There was just so much of it. But then the cycles turn, and now we have oil. I think is at $80 a barrel, right? So all those energy companies that were down in the dumps are now having the best year possible. So you can own a stock individually. So you can own Exxon in this particular example, or you could own a mutual fund with a bunch of energy or a bunch of utilities, Dominion, Florida Power and Light, Duke, something along that lines. You can get into real estate, and then there's real estate funds or real estate investment trusts, right? So REITs. And so you can either buy a house when all your risk is associated with that one house, or you can buy inside a portfolio of real estate assets and then have your risk diversified across multiple areas. You can do gold, which is a hedge for inflation, or you could do Bitcoin. You mentioned Coinbase, right? So you could do any one of the cryptos that are coming out right now, right? All of them argue for either an inflation hedge or a business utilization, right? Bitcoin says there's a finite amount of Bitcoin that can ever be mined. And so it is a hedge against inflation because there can never be anything more of it. Ethereum would argue that it has a business utilization due to blockchain. So there's some value to it, but it doesn't have the intrinsic value of an asset like gold or stock that has a piece of the company. Otherwise, you could go with a less or a more conservative approach, and you could lend your money to someone to use. So you could say, you go to the bank, you could buy a CD. You can put it in a money market account, and then the bank then or credit union would use the money that you put into that account or that they were giving, and then they'll loan it for something that's a little more risky. They pay for the risk. They undergo the risk, and then they give you an interest rate for the use of your money. And so you're not making as much because you're not bearing the risk, right? But you're getting a solid, well, not so much in these days and age, right? But you're getting a predictable rate of return on it. And the borrower is promising to repay you. And the more conservative it is, the higher the probability that you get all of your money back, right? Your money plus interest. So loaning or lending your money to someone who uses is a more conservative option for that allocation. But we're seeing today, right, in the last few months, we thought inflation might be transitory. It's trying to be a little bit more permanent. So 7.5% inflation, right, in spot areas, but the 5% overall. If you put your money into a fixed income asset or your savings account, and savings accounts are 0.25%,
Sure.
0.5%. If inflation is 5%, you're making 0.5%, then you're losing purchasing power on that dollar every year. So if you had $1, the next year you'd able to, you go to the dollar store, you could buy $1 something. The next year you can only buy something that's 95 cents. And every year that you have inflation, that dollar that you put into a long-term fixed interest is buying less. So your purchasing power is going down over time. So
Sure.
part of your asset allocation is you need to adjust that to address inflation. So if you go too conservative, you don't worry about losing your money in the near term, but in 4 or 5 years of inflation, you're getting 80 cents on the dollar because your money wasn't making as much money to keep up with the rate of inflation.
Right. So it comes back again around to risk and risk tolerance of, what's your level of risk tolerance to put towards different investments and how to allocate things to manage risk. You may think you're being more conservative,
right,
but you're actually risking more of your money because it loses its value.
Right. So there's internal risk, right? And then there's external risk, right? You have your internal risk tolerance. But if you go too conservative, you create a different risk, right?
Sure.
For future you will have a problem that current you does not. So
Right.
you have to take a look at the market dynamics and what your goals are, right? Clearly winning the lottery and having a couple $1 million makes risk optional.
Yes.
Right? You don't have to worry about it. But if you you say, hey, I'm never going to worry about it again, and we have a sustained rate of inflation, and you put all your money in a savings account because you never wanted to worry about it, you would find that you're not a multimillionaire by the time you wanted to retire.
Sure.
So inflation, and inflation hasn't been this high, but inflation has always been there, right? So it should always be a planning factor in your retirement planning, right? Everybody looks at the market going up and saying, "Oh, that's fantastic," right? But you have to say, "Hey, inflation means that the retirement house that you want right now, that's $100,000, is going to be $200,000 when you retire." So then you have that medical care is going to go up. The college tuition that you're planning for right now is going to be up when your child hits 18. So there's a lot of factors that go into your planning horizon, and the factors that go into it.
Right. No, that's a great point. That yeah, there's a lot of eyes on inflation right now because of how it spiked recently, but it is always there.
It's always been there, right?
And it's always going to be. Kind of like taxes.
Kind of like taxes.
So then, we did talk about some conservative investments. Can we talk about bonds a little bit? Those are one of the conservative ones.
Sure,
right?
And they are, right? So I mentioned, a bank, but it could be a company. A company will sell a bond a company needs to raise funds to achieve some effects, right? So they may do it by issuing stock, but if you issue too much stock, you dilute the value of the company. Because remember, stock is a sliver of the company. So what they may say is, "Hey, I don't want to put a bunch of stock out there, but interest rates are so low, maybe I want to sell a bond." Now, a risk-free bond is a U.S. Treasury. So risk-free means they typically have the lowest rate. So a 10-year bond at the bottom of the pandemic or height of the pandemic, depending on your point of view, it went below 1%, right? I think it was 0.6, so 0.5% at one point. But last week or this week, it was at 2%, right? But a company is not risk-free. So you're going to have to pay a premium on top of what the government is. So a company may pay 4% to somebody. So they'll say, "I'm going to issue you a bond, and you give me I need $10,000 to open a food truck, let's just say. And so I need $10,000 for the truck. So I sell you a bond, and I'll tell you, I'm going to give you 4% on that money. So now I am going to give you your principal back and the interest. But if my food truck doesn't pan out, the pandemic hits and nobody's downtown eating out of my food truck, well, I can either give you the truck or I'm going to default on the bond because I'm not selling any food from my truck. But I'll sell the truck, and then you'll get pennies on the dollar or some portion of it, right? So a default means they can't pay you back. But for the most part, if you do your research, most of these bonds are rated. Junk bond, a high yield bond is a more risky bond. They don't have it, but a highly respected company, and again, will be a lower rate, right? But a lesser chance of default. So you have the bond, and it has a par, the face value that it's originally sold for. And then you get that rate of interest that's called a coupon. And that's because every time some interest was due, you have a coupon book, and they take the coupon out, and then they would give you your interest, right? So that's
funny.
That's how. So you have your coupon rate, and that varies by time, right? So you have a 10-year bond, you have a 2-year treasury, you have a 30-year treasury. So liquidity risk is something that people look for. So the longer you tie up the money, the more you should be compensated for it, because you don't have use of your money. They have use of your money. So you should be compensated for that. So that will factor into the yield, which is your annual rate of return. And then it's not forever, like I said. So it could be so there's a maturity date. It could be a 2-year, 10-year, 30-year. And then between the start and the end is the term of the bond then. So a 10-year bond, right? And then in the end, it's part of a portfolio. A portfolio, it has risk measured by something called beta. And so what you want to do on your portfolio is diversify your assets so that you diversify your risk. So if you have a speculative growth stock, you think, yeah, I'm going to get a high rate of return on that, you might want to mitigate that risk by having some bonds, right? Slow and steady wins the race. So you have a tortoise in your bond, and then you have a hare in your speculative growth stock. And in the end, those two will balance out. So maybe as the growth stocks go, your bonds are performing, but as the market turns and the growth stocks aren't doing so well, but interest rates rising, then you find your fixed income is doing better. So as some rise, others fall, but on average, you continue that upward slope towards your financial goals.
Great. Yeah, no, and that's, you talked about it, risk, but again, mitigating that risk by having what you were saying with the portfolio of the tortoise and the hare, right?
Right.
Yeah. And then going back to the defaulting bonds. So that when you're looking into bonds, one of the things we're in the life insurance industry, so we talk about financial stability, right? A lot. So when you're looking at the financial stability of a company that's issuing a bond, where would you find, would you look up their credit rating? Is that
right? And there are external entities that will rate the quality of the bonds, right? And you instinctively can look at the current market environment, and you can look at what the company is offering. And so a company that is rated lower will typically offer a higher rate than a company that is rated higher. So, but in our particular case, we're reviewed externally. We have an allocation, and so we use these ratings of these companies, and then we allocate a certain part. We are looking for AAA, and maybe we can go down to some triple B, right? But there are rating agencies that will provide you the opportunity to know what the assessed strength of that company is before you go in the bonds. And so we mentioned earlier mutual funds, right? You can have a bond fund, and the bond funds, they can say you can select a bond fund. So if you want them and say, I don't want to go out there and spend all that time picking onesie twosies, you can just go to a high yield bond fund and you'll get a higher rate of return than a conservative bond fund.
Sure.
Right. And so, like I said, there's lots of people out there doing this for you. And so you have options, right?
Sure.
So it's, again, to your individual or the couple risk tolerance, right? And again, to reach back, part of that may be, hey, here's my time horizon, here's my goal. I have this much money, I can invest this much money, and I need this much money at the end. So there's a lot of this much, right? But in the end, it turns into a math problem. My present value is this much, my future value that I need is this much, I have this much time. What's the interest rate that I need to earn to achieve my financial objective? Right. And so you can just work a rheostat. And if you shorten the time horizon, the interest rate goes up. If you extend the time horizon, the interest rate goes down. Right. So you just need to figure out what is enough and then work towards that. And if the interest rate isn't enough to get you there, then you're going to have to put more money in earlier or over the length of it, or you're going to have to lower the expectations at the end.
Lowering expectations. No one likes to do that.
Yeah, no one likes to settle, especially in retirement, right? So.
Yeah. And then you did mention there's a lot of people out there to help you with this. And I think this also goes into another factor that maybe gets overlooked sometimes, like taxes, but like fees. How do fees come into place with investing in retirement funds?
Right. So a picture does 1,000 words. And for our listeners that have an ability to go take a look at the trifold that we built for this, right, you can see that fees are effectively a reduction on your growth year over year. So if the stock market goes up 7% per year, and that's your planning factor, but you're paying 1 or 2% in fees, then your rate of return is really 5%. So as you're sitting there making your planning, to the example that I just used, right? Here's my present value, here's my future value. I can afford to put this much money. Back when I started in an IRA was $2,000. All of our planning numbers was you want to maximize your IRA, right? So it's
Mhm.
put $2,000 a year into my IRA, and I do this, forever, and I get a 7% rate of return. Well, if you're in a company that is charging you a lot of fees, your planning factor, you're saying, okay, 7%, I'm going to get there with some room to spare. You're paying 1%. Really, you're only growing at 6%, and the market rate of return is only so much. So if you have fees, you'll never match the market performance, right? Because you're always paying fees, and the
Right.
more fees you pay, the lower your performance is, and either the longer your time horizon has to be, or the more money you need to put in. And if you're in a high fee environment, the more money you put in, the more fees you're going to pay.
Sure.
So it's a non-virtuous cycle. So that's for those, federal employees and military employees. One of the true benefits of the thrift savings plan is, in fact, the very low fees that you're paying.
Right.
But there's actively managed funds and there's passive managed funds. We mentioned index, funds earlier. So TSP is a passively managed. They have an allocation. The money comes in. They allocate accordingly because they're not paying, active management fees or the research or whatnot. Their fees are going down. And so now, in response, the market has created a bunch of low cost fee mutual funds as well. So it's a strength of the TSP, but the market that wants, always to grow and get more people inside of their funds, they're trying to match the benefit of the TSP. But if you're paying someone fees, you're not paying it yourself. So one of the old
Right.
saws is, right, you're not rich until your money works for you, not you for your money. In this case, your money, as much of your money isn't working for you as you think. It's going to that high fee company that you're paying. So you should always have an understanding of whatever your investment vehicle is, what are the fees you're paying, because that will directly impact your rate of return.
Yeah, no,
over the long
definitely.
term.
Yeah, and thanks for bringing up the brochure too. On our website for the podcast, we do have a graph that shows the impact of fees over time, and it's pretty significant.
Right. Yes, because just looking, it's a bar picture, and it just shows that, 1% fee, a 2% fee, or a 3% fees, for money that starts off at age 35 over 30 years, on $100,000 investment, the 2% fees, it could be a couple $100,000 difference, right? Because it's continual.
No, it's not a one-time event, and that's definitely an important factor to consider while you're deciding where to invest and how, and like what you were talking about of like passive versus active. Like, you have the potential to make more money with your investments if you're investing actively, because the person who's very experienced in managing that account can potentially make you more money than if you just are passively putting it and
Right.
allocating it in a fund.
And that's what the actively managed people will tell you all the time. But I think it was, again, Warren Buffett. I guess I'm a bit of a fan, but I'm pretty sure I'm recalling this correctly, that he made a wager with an active fund manager and said, pick the charity, but your active fund won't match the passive of the market. And in the end, Warren Buffett's fund, passively managed fund, worked. Because
Wow.
what we talked about before, right? The market goes up, the market goes down, and the active manager, unless they hit a home run on a particular stock, they don't know what the market's going to do on any given day, especially what's been going on recently. The volatility is up and down. Is there invasion? Is there non-invasion? Is there oil prices, or is there not insufficient oil? Is the pandemic worse? Is the pandemic better, right? So all
Sure.
this stuff is going to hard. It makes it hard. As good as you are in your research, there's externalities that are going to impact the market. And or you could have Robinhood saying, what's a really good stock to buy, right? And have all these people buy a stock that was going, GameStop, which is going out of business, right? And then and that cost a couple of hedge funds, though they closed up shop, right? But if you were diversified across the market rate whole, right, up then one day, down one day, on average, you're doing okay, right? And then similar to that, fees, right, is like we talked about taxes, right? So If you put your money into a tax deferred account, that money grows every year. And if you get dividends on that or distributions on that in that tax deferred account, you're not paying taxes. And so you have the ability for that growth to earn further growth. So you're getting compound interest going, right? So your money is compounding, as opposed to if you had a straight investment account and you got a distribution, you would pay taxes on it that year. You got dividends, you would pay taxes on that year. So that money is available for use for you, right? Because a tax deferred account, typically you can't get at that money. The benefit is for retirement, so you can't get at it until you're 59 and a half generally. And then if you do take it out before then, you're paying a penalty. So typically a 10% penalty, and whatever money that comes out of that goes right onto your income, right?
Mm-hmm.
So you're going to pay taxes on it. So that Uncle Sam always wants a taste, right? So they're going to get their tax on it. But if you can put that money in, you start off when you're 18 years old and you can put money into an account, and you can let it grow for 50, 60 years and never pay taxes on it. All those dividends year over year are building and begetting more and begetting more and begetting more. So again, the tax strategy and the vehicles that you use for tax deferred are important, right? And parents can use an education vehicle. 529 as a vehicle that is specifically used for education purposes, right? So you can put it in and you don't have to wait till you're 59 and a half. You put it in this education vehicle, it grows tax deferred, and anything that the funds from that 529 that are used for education purposes comes out. You don't have to pay taxes on that. If you use it for something outside of what the 529 was designed for, then you would pay a tax penalty, right? But when you pull money out for educational purposes, it's just you get to use it for that. So having an investment plan that understands the impact of taxes is a critical component of your financial planning.
Sure. Yeah. And I think we've talked about it before too, is that a lot of the time financial planners are a really great tool to help with deciding what's best for your family situation, where you're at. And, maybe if you're a family that doesn't have kids, then a 529 isn't really a good vehicle. But if you do, then that's a great opportunity to put money that you're never going to have to pay taxes on if it's used towards education.
And a good financial planner, there'll be, you want a fiduciary, right? So you want someone that is actively stating that they're in it for your benefit and not their own. Mm-hmm. So a fiduciary won't sell you a high fee because when you sell a high fee, you're getting a commission for doing that. A fiduciary won't do that. Fiduciary will ensure that they're planning for your benefit. And typically, there's continuing education and certification requirements so that chartered financial consultant or certified financial planning is going to be current on all things that are going on in the market and regulation too. So just in the last couple of years, we had the Secure Act, right? That changed, for example, how IRAs worked and how Roth IRAs worked, and they changed the required minimum distribution age. They moved it from 70 to 72, but they limited how long an heir can have a Roth IRA before they start taking distributions. So a certified planner is not going to have the emotional investment in whether it's a lake house or a farm for your retirement, right? Is it a condo in the city or is it in the country? But they can look at it dispassionately and say, whether it's the farm or the condo, right? You're looking to spend about this much. Mechanically, this is how you have to invest to achieve that end. And when changes do come, they can keep you current with those changes and adjust your plan accordingly. You don't need to have an RMD at 70 now. You can wait until you're 72, something along those lines.
Great. And I think as we kind of wrap up this conversation, because I think we touched on a little bit of everything involved in investments, but if you had maybe one or two key takeaways from this talk, what would you say?
I'd start as I ended with the beginning starts with the end. And to your point, an individual can have multiple time horizons, right? So there's no one investment vehicle right? And so if you have many goals and you have many time horizons, there are investment vehicles that can work to your benefit that you can apply them to. So you need to figure out your time horizon and what you're investing for, and then what your risk tolerance is. And then at that point, it's just a math equation, multiple tools out there, and you can invest accordingly. I think the second thing is you would have to have, just like you have an investment strategy, you need to have a tax strategy. And then part of that tax strategy needs to be, when you retire, your retirement income disbursement strategy. So if you, as I mentioned, right, if you put all your investments into a regular investment account and you forego tax deferred earnings, that will have a consequence. If you put all your money in a tax deferred income or tax deferred savings vehicle, but you need money to do a down payment on a house, you're going to pay a 10% penalty and have that whole down payment. So you want to be able to allocate according to your needs, right? Using your different investment vehicles, whether it be a tax deferred, tax free, or a regular investment vehicle, and understand what taxes are going to be in your retirement and what your distribution. So what your different vehicles are, how you want to take those money out. And the last thing is probably the single greatest factor in how your portfolio will do will be your diversification, right? Mm-hmm. It's your asset allocation. Like we talked about before, if you put all your money in the savings account because you want to sleep good at night and all your money is going into the mattress fund, yes, you'll sleep very well. You'll have lost or purchasing power over the life of your investments. Conversely, if you put it all in a very, very speculative stock and you can pick a dozen that have come and gone, right? Mm-hmm. Theranos is one that's been in the news recently, right? Evergrande, I think it is, the Chinese real estate company, right? So we have companies that go boom and then they go bust, right? So everything could go really great and you could be a millionaire 5 times over, and in the company, you put all your eggs in one basket and the company went bankrupt and now you have nothing. So you want to diversify your assets, that beta, right? So that you're getting a rate of return to achieve your financial goals, but not with so much risk that you risk losing it all at any given time.
Great. Well, thank you so much.
Well, thank you for having me.
A diverse portfolio is going to be your best bet when it comes to investing. Your time horizons and tax status are going to play into whatever type of investment you should choose. But ensuring that you invest in a mix of asset types at differing levels of risk will set you up for the future. Talk to a financial planner for help determining the best course of action for your individual scenario. If you're active duty military, you have access to free financial planning through the DoD Office of Financial Readiness. Thank you all for listening. Join us in our next episode where we discuss risk management. Visit info.navymutual.org/mutually speaking to access resources and information related to this episode, or submit a question to podcast@navymutual.org.